Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 360 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including potential headwinds for the market in August and September, year-to-date sector performance, and some new research on retirement. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you. So good morning, Matt.
Good morning, Mark. How you doing?
Good. It's apparently sweater weather in July in Dayton, Ohio. It was 55 degrees this morning, so nice and crisp. Wasn't expecting that, but here we are.
I embraced it. Last night, I was looking at the weather. I said, you know what? I'm wearing a long sleeve sweater tomorrow in July because I can.
That's right. I'll take it over 96 and deathly humid here like we've had for a couple of weeks.
You know what's going to happen next week to us?
Yeah, it's going to go right back up.
It'll go right back.
Right back up.
We'll take advantage. Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
As always, we will review the month-to-date and year-to-date performance of the major market indices that investors track. This data is from Y-Charts and as of the market close on July 22nd. S&P 500 index is flat for the month of July, but up 9.5% for the year. Dow Jones Industrial Average down 0.2% for the month and up 8.6% for the year. The NASDAQ Composite Index down 2% for the month and up 10.5% for the year. The Russell 2000 Small Cap Index down 2.2% for the month, but up 19.3% for the year. And the Vanguard All World X United States Index Fund is down 1.3% in July and up 12.4% for the year. 3-month Treasury rate at 3.89%, the 2-year at 4.31%, and the 10-year at 4.67%. Moving on to big headlines, current events from this week. It's been a busy week with earnings reports so far for some of the largest companies in the world. And that's going to continue into next week. So I think next week is actually probably the busiest week of earnings season if we're talking about the largest companies.
Yep.
And there was a stat from Bespoke. This was as of July 22nd at 12:53 p.m. They reported that with fewer than 100 earnings reports so far this season, we've seen 83% of stocks beat EPS or earnings estimates, and 84% beat sales or revenue estimates. 11% have raised guidance versus 3% that has lowered. So a good start, but obviously there's a lot more companies to report, but that's what we would want to see coming into the first couple of weeks of earnings, I would say.
It's encouraging.
It is. So again, if this earnings season is anything like last, I think the market will take kindly to it. So
One random thought I have on the market right now. It seems to me right now that short-term sentiment, I'm talking very short-term, is relatively negative right now. And as a contrarian, I'm good with that. Any thoughts, comments when I say that?
No, I feel like it's the same thing. We've kind of been chopping sideways here for about a month, and I feel like people are making it out to be worse than it is, but
I'm good with that. I'm good with that.
At this point in time, to me, it seems like a consolidation within an ongoing uptrend. So
yeah, well said.
It's not the worst thing in the world.
What are we within? Like a stone's throw of an all-time high? What are we within? 3%, maybe 4 max? And it's like people are like acting like we've sold off 10. And you know what? That's not a bad setup.
No, it's
Just want
not.
to throw it out there.
It's not. So the first thing I had was a article from Jeffrey Hirsch on July 17th titled "Summer Retreat Puts Seasonal Headwinds Back in Focus." So Jeff says, since 1990, August and September have consistently ranked among the weakest months of the year for U.S. equities. August has produced average declines in both the Dow Jones Industrial Average and the S&P 500, while the NASDAQ has managed only a marginal gain. September has been even more challenging, with all three major indices posting average losses over the past 3.5 decades. Strong bull markets can overcome historical tendencies, and unexpected economic or geopolitical developments can quickly change the market's direction. However, these recurring patterns serve as a valuable reminder that risk historically is increased during the summer, when the summer draws to a close. So I don't think this is any secret, Matt. I think we talk about this every year when we go into this period of the year. August and September usually aren't great for stocks, right?
Correct.
But the interesting part about that is the fourth quarter, or October, November, December, tend to be really strong for stocks.
They do, sir.
So again, if we get more of this consolidation that we're in, or if we get even a little bit more of a sell-off over the next 2 months, I don't think people need to freak out about it, because if it happens, on average, it happens most years, right?
That's well said. And I would also throw out, underneath the surface right now, earnings and earnings growth for the most part for the S&P 500 are relatively healthy. So that's going to buoy any sort of sell-off, even if it lasts a couple of months. So if you're a long-term investor, I think this is not a bad environment.
Yeah, it could be a buying opportunity. Second thing I had was a post on X from Blue Kurtik Market Insights on July 16th.
I've seen their stuff from time to time. It's pretty strong.
Yeah, so what they did was they, and this chart will be on our YouTube page, it'll be in our show notes, they posted a chart of the S&P 500 on the top half of the chart, and then the bottom half of the chart is the VIX, or the Volatility Index, the average seasonality over the last 20 years.
I like this.
And what you can see is focusing on that bottom panel, the VIX index, you can pretty clearly see that once we get to mid to late July, volatility tends to increase through about approximately the first couple weeks of October.
Yes.
So this lines up with what I just said.
It does.
Weakness in equities, volatility increases because they have that inverse relationship, right? So in my opinion, it just makes sense that we should be expecting some sort of volatility event or pullback over the next couple months. Now, it doesn't mean that it has to happen.
Sure.
But on average, over the past 20 years, we've gone through a couple of months here in Q3 that have brought some volatile times.
It tends to be the seasonal trend. When I see this, it makes me think of a piece I saw a couple of weeks ago where someone posted a stat that every time the VIX goes above the index level of 30, and how the forward returns are for the S&P 500 3, 6, and 12 months later. And it's only a matter of time before at one point we'll get back above 30. I'll do a search, I'll dig it up, and I'll talk about it on the podcast.
Yeah, I think it'd be good. We've thrown out some stats like that before, but kind of goes back to, Warren Buffett's old adage was, buy when there's blood in the streets, right?
Good one. I like that.
Last thing I had was a post on X this is from Jeffrey Hirsch on July 6th. He says, after a down Q1 and a 10% plus Q2, like we've had this year, the S&P 500 is 6 for 6 the rest of the year since 1950.
Juicy.
6 prior years, markets finished higher in Q3, Q4, the second half, and the full year. Small sample, powerful setup. Doesn't rule out August, September pullback, but odds favor gains through year end. So he put a chart along with this that it'll be up on the YouTube page. It'll be in our show notes, but shows each time that the S&P 500 was negative in Q1 and then up at least 10% in Q2. And then it shows the returns for Q3, Q4, the second half, and the full year. Second half average returns were 15%, up 100% of the time. Full year returns were up 19.3% on average for 100% positivity hit rate. So not the worst setup so far this year.
My observation is a majority of these, in my opinion, are recovery years, which I just find fascinating with different type of stats that we've talked about on this podcast. I'm going to spitball over the last 6 months or so, Mark. A lot of these years were years following poor markets. Have you noticed that?
Yeah, especially 2009.
Right? 03, 02
sucked, was bad. And it's interesting that this is the second year in a row this has happened. This happened last year too.
I find it very interesting.
Right. So again, small sample size, but I thought it was worth mentioning.
I like it.
We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
Okay, Mark, my first piece caught my eye from Bespoke. Timestamp on this, sir, July 21st. What they did is they posted a piece, and it's titled Number of Days as Top Performing Sector, 2026 year to date. Okay? And this was the narrative on their X post. I'll quote, "For all the bubble talk, there have only been 2 trading days all year when technology was the best performing sector on a year-to-date basis." Take that in for a second. Okay, because I just talked about, short-term sentiment and, it's going to kind of come in waves with people's thoughts on the tech sector. But according to Bespoke, energy, the sector of the market, has led all sectors 121 days, trading days so far this year through July 21st. Materials led 8 days, that sector. Industrials, 5. That surprised me, Mark. And technology, too. I will reserve my soapbox beyond those comments. Your thoughts?
Yeah, I think that the overall market has been so strong so far this year is kind of masking that some of these larger technology companies that make up a significant amount of the index really haven't done that great so far this year.
Some are in bad bear markets.
Right.
Name brands.
Which is kind of a head scratcher as to why people are still, drumming on this overvaluation bubble talk.
Do you think it's just like a clickbait thing? They just the powers that be that
I think they
financial news media, they know they're going to get the clicks if they do it.
Yeah, they hear it once and then they just start repeating it. Now obviously, like semiconductors, for example, have had quite the year so far this year.
Yep.
I'm not the one to judge if that's a bubble or if it's not a bubble, but
Aaron and I had the same roundtable last week.
I think that there's fundamentals there to back it up, which usually isn't a bubble in my opinion.
Yeah,
but
just depends on how long those get sustained
for a later date. But yeah, this is shocking to me. I would not have have guessed this, and I'm sure that it comes as a shock to everybody. But yeah, energy has been the one that has the leading baton so far year to date.
All right, I got another one for you. Ready?
Okay.
So this piece is from Bloomberg on July 20th, Mark. This stat has to do with S&P 500 revenues. What share of those revenues is derived outside the United States? Jenna will put up this chart for our YouTube viewers. I'll verbalize it for our traditional podcast listeners. What this is illustrating is it goes back, several decades. And we are now up to 42% of earnings are derived outside the U.S. To give you some comparisons, back about 5 years ago, that was closer to about 39%. And around 2016, that was at 35%. So we're definitely at the highest level on this data set going back to the early 90s. And the amount surprised me. Your thoughts and comments?
Yeah, I think it just goes to show you how more intertwined the global economy is getting, I guess, in my opinion. And I think currencies, are going to mean a lot more now than they did maybe even just 5-10 years ago, because you have to, have that currency conversion when you're converting back revenue and earnings from overseas, right? So with the dollar, like we talked about a couple of weeks ago, breaking out, I think now that means a little bit more, right?
Well said.
So I think that, maybe there might start to be some more eyes on the U.S. dollar going forward, and that could influence how, money managers are allocated.
That's well said. My last piece is kind of a quasi financial planning topic of the week. It's kind of in between. And this is a new study that I found by TIAA Institute Research. Okay. So TIAA produced the results, and I found it very interesting. Here we go. This is just some raw kind of data from the research. Ready? Only 24% of adults currently work with a financial tax/retirement advisor. So I found that stat interesting. Next, retirees are almost 2 times as likely as non-retirees to have hired a professional to manage their money. Next, biggest gap. Only 26% of advised retirees regret underestimating major life events versus 43% of those without an advisor. Next, advisor folks described planning as, quote, secure, end quote. Another term they use, confident. They also use the word excited. Non-advised lean towards the quote of overwhelming. And the other quote they put in the report is afraid of getting it wrong. I found it really, really interesting. So next, I'll call it the funding shift. Current retirees relied most on Social Security than pensions. Future retirees expect personal savings to be the number one source of living expenses in retirement, with Social Security being number 2. Confidence in Social Security splits hard by age, Mark, according to the report. 94% of boomers count on it, with just 51% of Gen Z. Next, another stat, 60% say they understand how to create lasting retirement income, but only 20% feel strongly confident versus 75% of actual retirees who say they secured it. Next, let's talk about the career angle. The average worker has had 4.2 employers. Found that interesting.
Very.
1 in 4 have left a job before vesting their retirement benefit. In essence, they forfeited some money, like match money. Next, 30% have rolled a 401k into an IRA. About 25% rolled it into a new employer plan. 70% of workers are offered a plan. 89% of those enroll. 60% of enrollees got there via auto enrollment.
That's been a good thing.
I would argue auto enrollment the last couple of decades, Mark, will down the road be a game changer for so many
Be
people.
life-saving for a lot of people.
So many people. I'll continue. The retirement age gap. Current retirees left work at age 57 on average. What do you think about that stat?
Younger than I would have expected.
Me too. Here we go. Current workers expect to retire at 62, and half think they'll delay it even further. 25% of non-retirees don't expect to ever fully retire. Next, regret and lifestyle stats. Check this out. 76% of retirees wish they started saving earlier. That doesn't surprise me.
The most popular comment that we get.
71% wish they saved more. I understand that. And then family time is the number one enjoyed activity in retirement. Travel is what people look forward to mostly beforehand, but it drops to number 3 when they're actually retired. I found the stats interesting. You know, Taylor does a great job at the firm and on the podcast discussing a lot of these financial planning topics of the week. When I saw the raw stats, Mark, I thought it'd be nice to kind of put some context into, you know, what the average American is thinking and how their behavior is. And I think the crux for this report for me is the value that a professional advisor brings to the table. If the market were always great, the need of a professional on the market side might be less. But when it comes to the planning side, it is just immensely important and valuable. Your thoughts and comments?
Yeah, I've said it before and I'll say it again. You know, I'm the type of person that always likes to use professionals in certain industries to get things done. So, you know, the example I think I always use is, for whatever reason, if I had to appear in court, I wouldn't represent myself because I wouldn't know what I'm doing, right? So it
would be a disaster for you.
It would be that's stating it lightly. But even other things too, like if I wanted to redo my driveway, like I'm not.
You and me aren't going to be out there with a jackhammer.
I have no idea how to do that, so I'm going to hire somebody to do that. So I think this can apply to things in life where you're not comfortable doing, or you don't feel like you have enough knowledge to do properly. You hire a professional to do that, and I feel like our industry is no different, although it seems that more people look at our industry and say, hey, I can save money, I can do it myself, which is fine, but there are professionals that have helped a lot of people in our industry, and it's something I think worth looking into, even though I'm biased.
One last comment. I do feel that when I look through the lens of history of our client base, most seek out a professional when a major life event ends up occurring, whether it's a pending retirement, death of a loved one, a divorce, birth of a child or grandchild. Go down the list. It tends to be changing of jobs. You go down the list of these major life events. That's when it kind of brings it into focus of, you know what? I'm not going to roll the dice and try to do this on my own. I don't want to mess this up. I'm going to go with a firm, an individual with experience who's guided others successfully through these types of life events.
Yeah. Usually when the stakes are higher, then it really makes people start to think about it a little bit more.
Well said. Any other final thoughts for our listeners and viewers before you and I sign off?
No, I don't think so. Trying to think. I don't think there's anything else worthy of it other than, again, just a friendly reminder. We're in the middle of earnings season.
Yep.
We talked earlier in the show about how we should expect some selling and some volatility over the next couple of months. That's normal, but when we get to Q4, it's the strongest part of any portion of this 4-year presidential cycle that starts in Q4 of this year and runs through the first half of 2027. So, looking back at history and price, even though if we might have some trouble here over the next couple of months, I think people will be pretty happy with where the market is probably a year from now.
I have nothing to add. I agree 100% on that.
Well, thanks everyone for listening to episode 360 of the Independent Advisors Podcast. Catch us next week for episode 361.
Take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Facebook, Twitter, LinkedIn, and X. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.